Hello, everyone, and thank you for joining us for Meeting the Demand for Understanding Risk and Financial Education. Today's program is in recognition of World Investor Week, which is a global recognition of investor education and investor protection brought to you by the members of IOSCO, the International Organization of Securities Commissions, and by us, the CFTC, and our guests today. Um, the program today will consist of two panels. The first is Teaching Risk to Educate Meme-Curious Investors, where we'll discuss what investors know and don't know about risk in investing, some of the new risks that they face today, and information that can help them avoid frauds and other missteps. We'll also talk about what educators can do to answer questions about risky investments and provide some resources that you can share with clients and customers, as well as become more familiar with the world of digital assets yourself. Following the panel, we'll take a brief break to swap out the speakers. And at 1:30, we'll start our second panel about the future of money, the changing landscape of currency, where you'll hear from leaders of the innovation hubs of U.S. regulators who will describe their agency's vision for the future and how they are responding to emerging market risks while protecting investors. Okay, let's meet our panel. Can we go to the slide, please? Next slide, please. All right. Toby Lee Beauchamp is managing editor of Learn at CoinDesk, where she oversees the content and initiatives to help people understand digital assets and how to safely invest in cryptocurrencies. Prior to CoinDesk, Beauchamp was the senior manager of educational content at TD Ameritrade and has also served as an editor at Yahoo, MSN, and Storyful. Andrea Clark has spent 30 plus years crisscrossing the country with her favorite husband, an Air Force officer. She is the mother of 4 military brats who have burned through all of the post 9/11 education benefits. Andrea was a 2009 military spouse FINRA fellow, where she earned her AFC credentials, and a 2016 scholarship recipient of from the American College Center for Military and Veterans Affairs to earn her CFP credentials. Andrea has worked with the military community as a personal financial counselor on a DoD contract for 13 years. She founded the Table Financial Planning, a fee-only private financial planning practice, in 2017. She serves households going through transitions of all types, with many military and veteran clients across the country and around the world. Next, we have Jerry Walsh, who joined FINRA in May 2006. She currently serves as the Senior Vice President of Investor Education at the Financial Industry Regulatory Authority. She is also president of the FINRA Investor Education Foundation, where she manages the foundation's strategic initiatives to educate and protect investors. Ms. Walsh received her JD from NYU School of Law and her BA magna cum laude from Amherst College. She is a member of the New York and District of Columbia bars. Last but not least, we have Shayla Moon. She serves as the Senior Director for Economic and Housing Policy for the National Urban League, where she focuses on equitable lending, community reinvestment, economic development, small business, and housing. Prior to joining the National Urban League, Ms. Moon served as a Senior Legislative Affairs Specialist with the Department of Commerce, where her efforts included expanding the Minority Business Development Agency programs and helping to draft legislation that codified the agency after 52 years in existence. Before beginning her federal civil service career, Shayla served in the U.S. Air Force as a government relations professional and for various political campaigns, trade associations, and nonprofit organizations. Thank you, panelists, for joining us today. Before we can dive in, though, I have one more piece of housekeeping to do. Next slide, please. As a good government agency, we always have to have a good disclaimer, and this is ours. So, this presentation is provided for the general information and informational and educational purposes only, and does not provide legal or investment advice, guidance, or interpretation to any individual or entity. The views presented herein are the speaker's own and do not necessarily reflect the views of the Commodity Futures Trading Commission or the commissioners. References to any products, services, or resources, or the use of any entity, organization, trade, firm, or corporation name do not constitute or imply endorsement, recommendation, or favoring by the CFTC or the United States government. The CFTC does not guarantee the accuracy or completeness of any information contained in third-party resources or websites referenced herein. All right, now to our panel. Now that we have all the particulars and requirements taken care of, let's jump in. Jerry, I know you've done a lot of research, and the FINRA Foundation has done a lot of research around how investor behaviors have changed since the pandemic. Can you tell us a little bit about that and what you've learned?
Absolutely. Thank you for having me here. During the height of the pandemic market volatility, we did a quick dive to understand what investors were doing. And we saw that there were a lot of younger people, from more diverse backgrounds, lower income, who are starting to get into the market in 2020. And so we wanted to take a deeper dive, and we took a look at what was motivating their behaviors, how they were making decisions, what kind of products they were investing in. And we saw that quite a few of newer investors were hopping into the market, in part because they wanted to take advantage of the swings and volatility, and in part because they wanted to save for long-term goals, specifically for retirement. So it was interesting to see that this group of people were entering the market who typically were less represented in the ranks of investors. It was exciting. It was like this democratization of investing. But investing for long-term goals like retirement, there are actually other vehicles that might make a little bit more sense than a taxable brokerage account. So thinking about, your retirement plan at work, for example. But we also asked questions about what was really driving people to come into the market. And again, that just ability to invest with lower dollar amounts, the availability of online platforms and web platforms that made it easier for people to invest were definitely some of the drivers. And we've done some more research since to follow up on that in a forthcoming report that we have coming out. I don't want to bore everybody with details, don't want to be like the disclaimer, right? But we do see that from 2018 to 2021, there was a marked shift in the face of the US investor, meaning people that are investing in taxable investment accounts. And it's younger, it is more diverse, and younger, newer investors, people who have only had their accounts open for a couple of years, comprise a larger proportion of the investing population overall. And among these new investors, they are much more likely to be trading options. We have a statistic that's fascinating. 36% of people under the age of 35 have traded options, compared to 8% of people over the age of 55. And we also see that these younger, newer investors are increasingly investing in cryptocurrencies. And among investors under the age of 35 and those with less than 2 years of experience, more than half have invested in cryptocurrency. So there is this incredible shift that over the past couple of years, and particularly during the pandemic, we've seen with respect to investors and investor behavior.
Very interesting. And I also noticed that in some of your research that a lot of the traders that were either coming in or coming back to the markets and that were taking on a lot of risk weren't always the younger people, but there were older people as well that were getting involved in much riskier investments too. Isn't that right?
That's absolutely right. In fact, when we were asking about the motivations for people going into the market, things like long-term goals, things like the availability to invest with small dollar amounts was a true motivator for the people who were younger and newer. And there was also a social element too, the fact that their friends were doing it and they wanted to see what it was all about. But with the experienced investors, the people who already had brokerage accounts, but decided to open up new brokerage accounts during the pandemic, they were looking to speculate. And one of the things that we saw overall is that there's a little bit of a disconnect in people's self-perception of their ability to withstand risk. And of course, that's the topic of our conversation today. And there's, how they actually behave, what sorts of products they invest in. So, we see newer investors taking risk, and people not understanding key investing concepts like diversification, but also not understanding how some of these riskier strategies like using margin or using options work, and feeling like they have the ability to withstand a lot of risk when in fact they have low income. It's like a triple threat.
Well, I know you do a lot of other research, and I know you have the National Financial Capability Survey coming out. With a lot of the research that you've done in terms of the behaviors that have occurred since the pandemic up to now, and some of the newer stuff, what really stands out to you as interesting, especially as it pertains to this conversation?
Well, the exciting news is that more and more people are investing, but particularly as it pertains to this conversation, it really is underscoring that element of risk and how people don't necessarily understand the risks that they're taking on. And, a personal fear that I have and that many have is that if people get burned in our markets, they don't necessarily come back. And I say that broadly. We saw that back after the Depression, right? After the stock market crash of 1929. This isn't new. But the mechanisms that people are using to interact with their accounts, it's much more disintermediated. They're not necessarily working with financial professionals. They don't necessarily have someone saying, hey, that's not a strategy that you should be engaging in, or here's a different strategy that would be more effective for your goals. And so people are doing it on their own, believing that they can withstand all kinds of risk, not understanding risk itself. And we don't want to see those people flee from the markets if something goes wrong.
Toby, let's turn to you. I'm sure you get a lot of questions from readers. Um, what tends to be some of the more common types of questions you get, and how do you categorize them?
Yeah, I would say there's two big, I see a ton of questions and I could go on forever, but there's two broad sort of trends I see in my work at CoinDesk, and there's the ones that are driven by news cycles. So a great example is the Kim Kardashian SEC Ethereum Max thing. So we saw a lot of people being like, well, what's Ethereum Max? Is it like Ethereum? What, so like there's this sort of person they know, something happens, and they want to understand what it was and what it does. And a lot of, we'll see like, is Ethereum Max related to Ethereum? And those kind of questions where people want to know, like, and the answer is no, it's not really. And that's one of the things that sort of people want to understand is like, how do you find out like, what is this X token or cryptocurrency? Where did it come from? How do they sort of find that out? And then we have sort of people who are like investors, and they're interested in coming into this space and they haven't been in it before. So they want to know like, well, how do I evaluate a cryptocurrency? What are some safe bets? What are some speculative bets, sort of looking into different kinds of cryptocurrencies? And then we see new people who are just sort of wondering, those kind of things that Jerry would say, like, it is very democratizing. You can invest with very little money. Like, how can I invest with $10? What can I do with this? But even sort of like what we see, and I've seen different trends around how, like, at this point, I think people know sort of the term NFT. There was a time when people were just like, they saw it and they're like, I don't know what these initials mean. Now they know what that is, and their questions are more evolved into like, are these for real? What do you really own? What is the value of these things? So it's pretty broad, but yeah, I would say like Ethereum is a good one because we just saw a lot of different cycles around like the merge that just happened. So people, that was a big enough event that it sort of crossed into mainstream coverage, and people wanted to know why and what was the big change, and like if they had Ethereum, how is it going to affect their investments? Or was this the time to buy Ethereum? So but we still see the basic, like, one of our top articles month over month is, what is Bitcoin? So that's a perennial.
Well, that's interesting. That kind of leads me to my next question, which is, I saw a survey and probably about a year ago that said roughly a third of current Bitcoin owners or cryptocurrency owners don't really know what it is and can't really explain it. And I know that CoinDesk is also involved with the crypto literacy project. So what have you learned from that about what people actually know and don't know about what it is they actually own?
Yeah, that's a great question. And I think, we did a survey last year and we're doing another one this year. We sort of we partnered with for this thing called Crypto Literacy Month with CoinMe and our parent company, DCG Digital Currency Group, to really promote consumer education around digital assets. So we started with like a survey, which we used YouGov last year to sort of say, all right, if you do you own cryptocurrency and what do you know? And sort of, so like, it was really a pretty big gulf we saw last year, frankly. So like a lot of people who said they own Bitcoin didn't answer, I think, wouldn't have gotten a quote passing grade on the literacy quiz we gave them. So they didn't really know, something like what's Bitcoin mining. We found that most people didn't know what Bitcoin has a maximum supply of 21 million, that it could be broken into smaller units called Satoshis. Which is how you're allowed to buy less than one whole Bitcoin. And, when we did that survey, it was, at the time when Bitcoin was at a huge, very high price point that it's no longer at. So the idea that you had to buy one Bitcoin was a barrier to entry to a lot of people, but, sort of still people that own Bitcoin, but not understood these sort of fundamental things. And, as an educator, a lot of what I do is sort of say, well, does it really matter if you understand that do you have to understand that there's 21 million Bitcoin that are ever be created, or do you need to understand that there's a finite amount to understand sort of how the mechanics of it work? And like, do you need to know it's called Satoshis? Probably not. But do you have to understand that it can be fractionalized? Yes, because it's very different than like a Berkshire Hathaway, which never had a stock split and never has fractionalized stock. So you can't buy less than one. I think it's still at like $65,000 a share of that company. So we're excited to do it again and sort of see what the delta is between last year and this year. We're just about to finish up the survey period of that, so we don't know the results at this point.
Great, thank you. Shayla, there were a number of surveys, or recently there have been a number of surveys and articles about adoption rates of cryptocurrency and digital assets among African American and Latino communities. What do you think has fueled that interest?
Well, again, Dan, thank you for having me on this panel. I think a huge part of this has been what we've seen through the course of the pandemic, as well as the large number of minority community on various platforms and being influenced by influencers, celebrities, politicians, and driven to support cryptocurrency and other digital assets. Certainly historically, with communities of color of being underbanked or unbanked, or certainly being in banking deserts, cryptocurrency has provided opportunities for them to participate, but most importantly, take the agency of their own financial well-being and financial growth. Certainly, with all things, we have had concerns about, the need of capital and the capital that is being driven into cryptocurrencies, particularly for communities of color that don't necessarily have capital to lose. And with the market being so volatile, the concern about, what is driving and fueling this. We have seen NFTs coming from several celebrities. We have seen cryptocurrencies and NFTs utilized in gaming platforms as well as social media. And the concern is certainly, the loss of these assets. Capital in our community is such a hard thing to come by. Historically, we take into account even the Freedmen's Bank, unregulated banking institutions. And as cryptocurrencies is such, lacking regulation right now, we see, many of these other social media driven components of wealth building being focused upon, but also without any clear backing or as well as any clear understanding of financial literacy coming from other community leaders.
Right, I'm sure they're not talking about, what are the prospective dangers of something like this, but more talking or promoting, getting involved in whatever the particular coin of the day is. Is that your assessment as well?
of that is our assessment. Certainly we know communities of color are often driven by leadership, coming from certainly at the academy, coming from our religious institutions, as well as our community organizations. And, by all means, we actively support, what we're seeing now of get the bag, and in using, current vernacular, just like YOLO, certainly not stopping any barrier of anyone to acquire wealth and gain wealth. But the biggest concern is certainly the loss of that wealth, the loss of that capital, as well as other assets and resources that may be drained for the utilization of what often many see as a get-rich scheme.
And Jerry mentioned that a lot of times when people get burned or get scammed, that they tend to leave the market, leave investing, leave the financial system. Do you see that also as sort of a threat?
That is also the concern that, cryptocurrency will certainly, as mentioned, it creates opportunity for those to participate in their financial well-being, but it also takes away interest and also brings a deeper distrust for the existing brick and mortar institutions that we have come to utilize. We encourage all of our constituents, our community members, certainly to build and foster healthy relationships with banking institutions. And as certainly digital assets is presenting an opportunity, we want to ensure that there is something that is regulated that will reinforce opportunities for other asset attainment, like mortgages, like small business loans, that cryptocurrency right now is not able to actively provide.
Right, and actually that's where the risk education comes in, right? And then how to balance those assets across different, or how to balance your wealth across different asset types, right?
Absolutely.
Andrea, turning to you, I kind of put the same question to you. What do you see in the military community, and what questions or what concerns do you have? Oh, you're on mute. Still can't hear you.
There we go.
There we go.
Thanks, Dan, for having me on this panel. It's really a great group to be part of. I've kind of been boots on the ground for a lot of years compared to some of my fellow panelists. And, the initial conversations around, especially cryptocurrency, were with young service members who were stationed outside the United States. And, the idea of it is super appealing when you are sitting outside your home country and there's this currency that is, a peer-to-peer payment system that might make it easier for you to live your life outside of the US. It's no wonder that so many people were interested in it. And the first questions I would get tended to come from the service members who had been outside the country and had a little more exposure to it, maybe. It's also something that is so mobile. So service members are always on the move, and they don't put down roots. And something that, like Jerry was saying, the bar has been lowered to get into those markets, and it's something you can do from your smartphone. So it fits in really well with the mobile military life. Service members, it's kind of the opposite of what Shayla was saying. They are a community that has a stable income. So sometimes it's hard to convince them that, you're going to be preyed upon because of this. And a lot of these social media campaigns that are focused on the younger generation, especially those that have some income, they tend to fall prey to scams in particular, but they're just willing to take a little bit of risk. And it's also, the military population is not a risk-averse population. They've raised their hands to fight for their country. So they have a little bit of a different mental makeup when it comes to investing. I do see them, though, get burned by it. And, unfortunately, that does make them draw back and be more risk-averse. And so that's a problem I see too in counseling the younger service members. But, as time went on, the questions come from everywhere. It's not just the young people, it's everyone. And I think the recent volatility in the market has made some of the older clients and service members I work with draw back a little bit, because they do have that historical knowledge of past downturns. But young people, a lot of times they have a lot of competing priorities. And especially the cryptocurrency, with that idea of, make a lot of money quick, it makes them feel good about maybe being able to meet more of, have more assets to serve those different competing priorities in their financial lives.
Right. Now, I know you're a counselor. I'm sure you talk to other counselors, and you go to meetings and that sort of thing. How do counselors approach some of these ideas, options, meme stocks, and cryptocurrency?
Well, risk education is all important. I will tell you that I hesitated to talk about cryptocurrency in the beginning just because I didn't understand what it was. I didn't understand where it came from. And a great analogy is, you don't have to understand how a car is made to be able to educate consumers and investors on how it fits into their financial life. So I hope that, counselors and educators and coaches can kind of keep that in mind, that you don't necessarily have to understand all the ins and outs of cryptocurrency, about futures trading, but we do understand the increased risk that comes with some of these assets and some of these investing behaviors, and putting it into context. And, it's an uphill battle for us because what we have to offer is not as sexy and exciting as what social media has to offer with cryptocurrency and futures trading and the get rich quick schemes. So
yeah, no one likes to eat the vegetables.
Right. Yeah, it's a tough sell. And, really all I can say to counselors and coaches out there is, when people come to you and they're asking questions about cryptocurrency, get to their why. I often say people bury the lead and they're probably worried about something else. Maybe they grew up poor and the idea of having access to a lot of money quickly is really appealing to them. Maybe they're carrying a large debt load. A lot of people don't like to talk about the debt that they carry, and they see this as a solution, this quick access to investments that they might make a killing in. Or maybe they just feel like, I think Jerry was saying, there are more older investors coming to some of these platforms, and maybe they feel like they started late. They're late to the game and they're trying to make up ground. So getting to people's why is when you're going to be able to really connect with them and educate them and share the financial literacy that you have about risk.
And I think I'll take this opportunity to say to all the educators out there in the audience to share your stories. If you've gotten questions from people that you counsel or talk to, or if you have questions yourself, drop them in the chat. Now, unfortunately, the way the Zoom call was set up, you won't be able to see the chats or the comments from other participants, but don't let that discourage you. They'll be shown to the panelists and we'll be collecting those. And if we don't get an opportunity to answer your questions, just know that it's something that we're going to be sharing not only amongst ourselves, but we'll also be looking at it as we develop at the CFTC and other government agencies, as we develop new materials and share some of what we learn from you. It's always a great opportunity to hear from the public. So let me open this question up to everyone, and we'll start with Jerry and maybe go around the horn. What makes risk education so hard?
All right, raise your hand if you've got teenagers, right? Or if you've ever had teenagers. Raise your hand if you've ever had a toddler, right? We don't want to be told that we can't, that we shouldn't, right? And we all think that we've got superpowers and that we're able to absorb risk, but it's really hard to get people to conceptualize what that risk looks like. If you're standing on a bridge thinking about bungee jumping into a gorge, right? You're feeling the wind, right? You're seeing the distance. There are a lot of physical inputs, a lot of sight, sound, smell, touch, all that. So you can kind of like, yeah, I'm not going over that ledge, or I am. But with investing, it's a little bit more attenuated, right? And especially if you're not taking money out of your pocket, right? Hard, cold cash. Instead, it's in an account and the trade confirmations don't show up for X amount of time. And, you see your portfolio grow or shrink, like it's all a little bit abstract. And so it really is difficult to get people to realize that there are not only risks to particular types of products and strategies, but there's general market risk that exists. There's your own ability to absorb loss, your need for liquid assets. But then beyond that, if you lose the money, what could happen? Andrea was talking about the why. It's really important when people are investing to think, okay, what is this? How does it work? What am I paying for it? And how could it go wrong? What could go wrong? Might the company go bankrupt? Might I be stuck being unable to liquidate my cryptocurrency investment, right? Basically, 1 in 6 people couldn't, from cryptocurrency research that we did with NORC at the University of Chicago. I think that's all those reasons pile into why it's so hard to educate people to absorb concepts related to risk.
Andrea, what do you think?
What Jerry is saying, it's hard for them to understand it. It's also hard for people to separate risk from volatility. So, they've seen the stock markets go up and down in the past, and we've seen crypto move in some of the same ways recently, but it's not the same kind of asset. It might have the same kind of volatility, but, like an example I've given to a lot of clients recently is, yes, everything is way down, but it's the value of a share. For instance, in the S&P 500, the top 500 companies in the country, the value of their share is down, but the products and services that they offer are still around. Cryptocurrency is a different thing, especially when you get away from some of the more established currencies like Bitcoin and Ethereum. It could be worth nothing someday, and you have no recourse. So you have to be willing to lose it all. And it's just a different proposition than, the tried and true index funds in the market that, they're not very exciting, they're bread and butter, but they get the job done, and helping people understand that it all has risk and volatility, but it's not all the same.
Shayla, any comment?
I certainly want to say that, we have to understand what are the risk of peer pressure, the risk of celebrity. Understanding that, certainly as we are in such a consumer-driven society right now, where we see celebrities fed through not only social media, but our regular televisions and programming. And as we all aspire to be at that level of celebrity, that level of leadership, understanding certainly the capital and opportunities that they have that the average individual may not. Certainly to cover that loss, that is a part of these volatile and unregulated markets. Understanding the threats of cybersecurity, because crypto is such a internet and social media driven opportunity and asset. Understanding the threat of loss, the threat of, as mentioned, the loss of passwords being stolen, or immediately not having access to that internet driven business moving forward. The other thing is that I want to highlight one thing as we're talking about mitigating risk of who we're following. We are taking into account, who are really the people educating us. Are we following rappers? Are we following artists? Are we following politicians? Who truly is the voice in educating our communities of what cryptocurrency is, the opportunities associated with it, let alone the dangers of what happens and what to do when these monies and resources and assets are lost.
Yeah, you raise a terrific point. I mean, understanding that, the risk in terms of the information or misinformation you get is compounded by social media, because it will concentrate that conversation and the sources of information that you get around a particular topic once you start following it and start liking it and start, monitoring it or what have you. So yeah, that's a very good point. Thank you for raising that. Toby, what are your thoughts?
Yeah, I mean, everyone brought up a lot of great points, and I think inherently cryptocurrency is a highly speculative thing and risky right now. And there are Bitcoin and Ethereum, but there are 18,000 cryptocurrencies or something, and just understanding sort of how to even look at those cryptocurrencies. So if they're ones that go back to the Ethereum Max, like if it was, I think when Kim Kardashian posted that thing, it was about a month old. It had been around. And would you put your money in a company that had only started a month ago and had no actual product yet to have a value? Like, it had all these promises, these were the plans. And like, if you actually did a little bit of research, like you would see spelling errors on their website, you would see, a lot of problems that, sort of should have been red flagged. And In fact, sophisticated Nigerian scammers for years have done sort of intentional misspellings to actually weed out more sophisticated people, to weed in a funnel of more susceptible marks. So, sometimes that's a feature, not a bug. But I think, trying to say back to that why point, it's like, why do you trust this person or this information? How are you getting this information is a really good place to start. But also a good opportunity, I think, for us, when we see an opportunity, we try to sort of that eat your vegetables thing, I obviously have a ton of informational, it's like how to avoid scams, but when it comes up, at CoinDesk, we really try to weave it in, like, here are some things, here's some resources within the story we're already telling, so we can sort of upskill people as they're learning about something they're already interested in. It's an important, sort of weaving in of information. But yeah, it's very hard. And we find a lot of people who have, sort of the Dunning-Kruger problem, in which they know a little bit about cryptocurrency. So, to bring it back to the literacy, like, people are already buying Bitcoin. They know it's the first cryptocurrency. They know there was this guy, maybe Satoshi Nakamoto, who's a synonymous person. But when you really probe it, they don't actually know very much about the fundamentals of sort of like, how it's being created and how it works and how it sort of works as a peer-to-peer thing. So that is a gap. And then I just saw in the chat someone talking about FOMO, and that's another thing. Like, people really want to, when we saw the meme stocks or any of the sort of explosion of ebullience in cryptocurrencies, people are very afraid they're missing out on their one chance at wealth building, that like this once in a lifetime thing, and they want to jump in before they, lose out on this opportunity. But I think it's important to really say you have to take a step back and measure sort of, what is the opportunity? Why are you doing it? What is your risk, sort of profile? Like, what are you willing to sort of like lose to like, I had a lot of friends who bought Dogecoin when Elon Musk was on SNL, and that was the only reason they had. It's not a great reason. So
yeah, we've started a new phrase or what have you in our office. Make a plan, learn the markets, know the risks, and if you cover those bases, then you're more likely to make at least a little smarter decision. Making a plan kind of takes you out of the emotional state and makes you think rationally and plan ahead and think about the upsides and the downsides. Knowing the markets is important because futures markets aren't the same as crypto markets, aren't the same as options markets, and so you really have to know the differences and the terminology and the language between those markets. And then knowing the risks that's the fundamentals. Not only how much capital can you afford to speculate with or to invest, but what does the loss of that capital mean? And knowing sort of when to exit the market is just as important as knowing when to get in. And I think a lot of people forget about that point. And it was when Jerry was talking about her bungee jumping experience, I was thinking about, I used to work for not an agency, but an organization that would do a lot of conventioning in Las Vegas. And it was interesting to see the new people who would kind of join the organization, and they would really look forward to that first meeting, and going to Vegas, and it's, they're going to the casino and they're going to do great. And then, they'll get in there and they'll put their money down. And then at the end of the 3 days or what have you, of course, they've lost most of their money. And now I can understand how people can come into, an investment thinking with that optimism, with that opportunity in mind. But really what you were getting to, Toby, was you really got to think of them like an underwriter. Like, do you really want to lend this guy money? What are the chances this is going to pay you back? And look at it more critically and more fundamentally. Shayla, did you have a?
Yeah, I have a point, and something I want to flag. Something that I think we all need to be paying attention to is the predatory opportunities and being able to identify them. I'm of a certain age of remembering, college registration and going through that process and seeing 3 to 4 credit card tables lined up, ready to sign me up. 20-year-old me excited to get a credit card, but not understanding the threats and risks that would probably follow me for the next 25 years. being able to identify, what are these predatory practices of how we are receiving information, how it's being presented to us as consumers, but also being very mindful of, what are the different systems that certainly may have impact to certain communities. Old enough to remember Amway, old enough to remember prepaid legal, but also being very mindful of this, as I said, consumer-driven market where we're trying to keep up with the Joneses. For college students, it's homecoming season. You want to be able to utilize any asset and resource you can to get these tickets, to, be there with the crazy Camerons. I'm a Duke fan, so, go Duke. So certainly, how, these resources are also going to be expended. It is utilized for video games, as I know that, certainly many of, those streaming markets for gaming, we're seeing a lot of these things presented to youth too. And also trying to regulate, as Bitcoin is utilized, how these things are going to be circulated within the market.
Absolutely.
If I could add something, I saw that in the chat, there was a question about FOMO. And I think, like Shayla just said, the keeping up with the Joneses. And Dan, your comment about making a plan is so important to help people get focused in on the fact that they are unique, that they don't have to beat the market, that they don't have to get rich quick, that, time and discipline is what they need. And, it's not a beating the market strategy, but rather a, what are my goals and how can I achieve those with the assets that I have?
Right. Well, I have a hard question, and I'm going to put this one to Toby as the journalist on the panel.
Sure.
Do you think the industry or the media has done a good job of talking about risks in these investments?
I mean, I think, the industry as a whole has done, like if you look at the big platforms like Coinbase or Kraken or Binance, they have dedicated a large portion of funds and real estate on their sites to education. But, you have to take it with a grain of salt, because while they'll talk about risk, their goal is to convert you into a customer. Like that is their goal. And I think, to go to some of the points raised earlier, is like, what's in it for them? You have to sort of ask, I think Shayla, sort of the credit card tables, that's the credit card table. Like I think it's great that Coinbase, for instance, has, a learn to earn thing. So you can learn about a cryptocurrency, but then at the end of it, you do get that cryptocurrency. And what does that mean for that, sort of like who paid for that? And what was the motivation for all of these things? These are questions you should be going through the back of your mind. Like if you're getting something for free, why? And is it really for free? I think, there are cycles of sort of in media as a whole, especially outside. I think CoinDesk and sort of the crypto focused, we're pretty good at, being upfront with what we know and the risks, and, we're not investment advice. But like especially during like sort of like the NFT boom, there was sort of just like this sort of frenzy of coverage of apes and parties, and it really fueled that FOMO without putting some of the risk. Like if you were someone who was lucky enough to buy a Bored Ape Yacht Club NFT when it was still affordable, now you have this great thing. It's highly illiquid. So like there's this other challenge that comes at the end of that. Like even somebody who has this ape, how many people in the world are going to spend $1 million on that from you? So, I mean, great. But I think so. But on the other side of that, most NFTs didn't see that kind of growth or that kind of success. So like, people spent a lot of money on things in that kind of FOMO fueled thing. So I think journalism can do a better job when they're covering some of these success stories that, in just sort of caveating a little bit better around, knowing that this is an exception. Right now, we're seeing a lot less of that kind of, we're in a crypto winter, as they call it, or a bear market. So there's a lot more, and there's a lot of stories of huge losses and, bankruptcies and people getting, losing all their money. So I think, that's the other side of the coin, and people are covering that pretty well and how it all happened. Whether or not people are interested in the story of why, 3 Hours Capital sort of collapsed and what went behind that. Is there as good an interest in that as there is in the sort of, millionaires on a yacht having champagne and, their private parties? That's the challenge. Which side of the attention coin can we get people at?
Yeah. Jerry, you and the FINRA Foundation and FINRA and our agency and others, in fact, most of the federal agencies out there deal a lot with fraud. And there's been a lot of discussion about fraud and how much fraud has really grown in the space. Can you talk a little bit about what is risk education? How does that help prepare people or help them avoid fraud?
Well, one of the things that the foundation has been exploring is sort of what makes people susceptible to particularly investment fraud, but different types of financial fraud generally. And there are differences. Different types of financial schemes will pull on different heartstrings. They will literally tap into different emotions because fundamentally, all of this is about emotion. It's all about whipping up whoever the target or the mark that the fraudster has into an emotional state, whether positive or negative, so that they make a decision based on that non-rational part of their brain. And so we have been exploring teaching people about persuasion, echoing what Toby was talking about. You know, there is a lot of education out there, right? Regulators, media outlets, industry, influencers. There's a lot of educational material out there, but how do you sort through what's good and bad? And how do you understand what types of persuasion is going on? I mean, fundamentally with scams, the con is trying to take your money. That is what they're trying to do. And whether it's that they promise you a lifetime of love, that having lost your partner, they're going to be your new spouse, or it's the opportunity that just sounds really amazing and it sounds like it actually could be good, right? It's not too good to be true. It's actually real. You know, all of that uses very sophisticated persuasion tactics that are commonly used in marketing. And so one of the things that we encourage educators and counselors and coaches to do is to help the people that they're working with, help the people in their lives understand persuasion. And Andrea and Shayla and Toby were all sort of echoing the different questions to ask, right? Why me? Why am I getting targeted with this great opportunity, right? What's in it for the person who's selling? What could go wrong with the investment? Because people are constantly dangling phantom riches, right? That opportunity that really is amazing and is going to be your path to financial success. They're saying that all of the people in your community, whether it's by your profession, by your gender, your race or ethnicity, you know, whatever it is, everybody is in it, right? That it's a really good deal. And so you should be doing it too. All those tactics are the fundamental persuasion tactics that cons use. And we've done research with the university, USC, Caesar, University of Southern California, sorry, on looking at whether there's some stickiness to some of the messages that can help with fraud prevention. And what we do see is that there are some promising practices that educators can engage in to help people better understand persuasion that aren't a heavy lift and that do have some staying power with people. But you constantly have to bang that drum. Always come back to your goals. Always think about what it's going to cost you. Always think about what could go wrong.
Andrea, as the counselor on the panel, any additional thoughts?
All the things that Jerry was just talking about made me think of a couple of books that have been really popular in the counselor and coaching community recently. One of them is called Predictably Irrational, and the other one is called Nudge. And like she's saying, it's understanding the emotional pull of all of these types of investments and being able to have conversations about why it's attractive. And I just would encourage everybody to, you know, those two books are great resources for understanding behavioral finance a little bit better, and the studies that have been done on, you know, what gets people to take positive actions in their financial life too. It's not just avoiding scams, but educating them on, you know, moving ahead and taking that next best step in their financial life.
Shayla, we talked a lot about you know, how folks are targeted by media and the impact of media. as a boring government agency, and speaking for the boring government agencies out there that are listening, how do we compete? How do we get our message into the hearts and minds of the people that need it? And what is it that folks in the field can use from us? What can we provide that will be effective?
Well, coming from a boring agency, I understand the importance of public-private partnerships. And working with community-based organizations that focus on financial literacy. At the National Urban League, we have 92 affiliates that do provide financial literacy across the country. But that is driven through our partnerships of working with banking institutions and organizations, banking with and partnering with CDFIs, and partnering with even those in the academy to have a broad range of how we are touching with various community members, those who are seniors, those who are in the military, those who are in higher ed, and even those who are even of school age, and understanding the basics of how to make the money work for them, and understanding why they are purchasing, and if not also consuming certain products. We are heavily focused at the league of certainly working with organizations and working with entities that are educating consumers of not only the risks, but also the opportunities associated with building their financial history, most importantly, building their financial relationships, and then being able to grow and expound upon that. So, cryptocurrencies and digital assets is just one key piece of the education that we are trying to provide to our consumers, and helping them understand that, certainly as you are gaining capital, what helps make their money work for them, as well as other investments, not limited only to digital assets.
Great, thank you. And again, I wholly agree. I completely agree with working with community organizations and having those partnerships. And I'm going to put my email up here at the end of the presentation. So if there are any out there that want to work together, feel free to reach out to us. And we certainly look forward to engaging the public on these and other topics. Toby, what are your thoughts as someone who works in media and works online? What are some ways to kind of compete with all the sort of marketing messages and other messages that we hear out there?
Yeah, I mean, I think, part of it is, being a responsible organization and outlet, and really, I think trying to, there is a sort of crypto journalism group, and like trying to figure out how we can better educate the non sort of native people. Like I came from traditional finance, and I had to learn myself, and sort of knowing how you can find those places, but also then, in a way, sort of like everyone sort of needs a lot of media literacy training generally. Like how to trust sources and find trusted sources, and like know what back to the why, like, I get a lot of pitches that are just, they seem like an interesting, but when you dig into them, you're sort of saying, oh, this is just highly promotional. And if we give it oxygen, we are actually aiding this problem of sort of pumping up, they call, there's pump and dump schemes, or so understanding what that looks like. And so like, even at the journalism level or like the media level, there is work to be done there. But so continuing that, but, again, speaking to people where they are, trying to find, like, working on the crypto literacy month, and it really is sort of trying to outreach and try to find other ways to talk to people, looking at different groups that are more sort of on the ground with people who are like early. There are a lot of communities that are adopting crypto at a larger rate. So how can we speak with those people and provide education, like, on the ground, rather than wait for people to come to us? So, it's definitely a challenge. And, raising our hands when somebody invites us to speak at a mainstream event is helpful to have that voice to say, like, here are some easy, or not easy, but just simple, accessible things. Because I think that's one of the big challenges with education in this space, is that everyone just feels like it's so hard they can't even get started, and that it's beyond them to even know how to do sort of the most basic assessment of the risks. But it really isn't. So like, just trying to be clear with that message and provide those informations in as many ways as possible. And we have, obviously our own social media accounts, and try to use those for good as well. But
Jerry, I know you've done some research in this space yourself, so any thoughts that you'd like to add?
Oh, I would just underscore everything that Toby just said. She said it beautifully.
Thank you, Jerry.
Well, and I wanted to add to something Toby said about education and, kind of grassroots initiatives, boots on the ground. So my accredited financial counselor certification comes through an organization called AFCPE, and they do offer community grants. So, if you know of a local organization, everybody listening today that could use, a leg up in helping educate their community on some of these topics, the resources are out there. And I would encourage you to take advantage of that. As someone who works with the military community, we have a couple of other great resources out there as well that the Office of the Secretary of Defense, we have the Office for Financial Readiness, and they do a great job of providing education to service members in particular that doesn't have any kind of corporate sponsorship. So you don't have to worry about the advertising and the strings that are attached, and also the Consumer Financial Protection Board. So, those are great places to start. They have educational programs to take advantage of. FINRA has a great educational program to take advantage of. I know, I was part of that, and I'm very thankful. So those are just some of the other resources that my community uses to promote financial literacy.
Well, maybe I can help provide some more. That's a great segue to our next section. Can we put up those slides, please? I believe it's slide 4, maybe. Lene? Hello? Can we put up the PowerPoint?
Dan, while we're waiting for the slides, there was a question that I saw in the chat that kind of gets at the issue of how you register shares of a company, like how you own your stock, whether you have it in street name or direct registration or all those kinds of things. And I'm aware that there has been a buzz on social media about having shares in your own name instead of holding them through a broker dealer. And there are mechanisms. The Securities and Exchange Commission actually has some great information on different ways that you can hold your securities. And there are advantages and disadvantages to each. But that kind of question about like, well, shouldn't I do this, right? It often comes from effectively not so much a meme stock, but a meme about investing, that into invest wisely, you should do X, right? You simplify into a tweet length piece of advice, something that is far more nuanced and far more, important for people to think carefully about, right? You always want to think about what your goals are. Andrea was underscoring this, let me underscore it as well. It comes down to your why and what makes sense for you. And the risk of having shares in your own name rather than through a broker dealer is frankly that if you want to sell, you may not be able to do so as quickly and at the price that you want, depending on the contract that you have with however you're holding your securities. So there are upsides and downsides to everything. When people only focus on the upside, the amount of money that you can make or the strategy that you ought to be using, always come back to think about what could go wrong? What's the downside?
Right. Thank you, Jerry. There we go. So can you see the slides now? There we go. There they are. Okay. So thank you to the AV team for being there for us. As I was saying, we created some additional new resources that hopefully will be helpful for those of you who are teaching about some of these risks. We created 3 new flyers. The first one here is 14 risks to remember, and I'm not going to read through them all, but I'll maybe highlight a few that we talked about. First is unsupervised trading. The digital cryptocurrency cash markets are largely unregulated. The CFTC really only has supervision jurisdiction or regulatory jurisdiction over the derivatives markets, but we do have enforcement authority when there's fraud or manipulation that occurs in the cash markets, but we really don't have visibility into what happens in those markets on a day-to-day basis or minute-by-minute basis, and so they're not as well supervised as perhaps the other more traditional exchanges that you may be more familiar with. Inconsistent customer protections, commingled customer assets. Now, a lot of people, when they start learning about Bitcoin and blockchain, assume that when they go to an exchange, that when they make a transaction or when they make a purchase, that the cryptocurrency that they buy is added to the blockchain right away. Well, sometimes that may be true and sometimes it's not, depending on the exchange, because some of those funds might be held in a sort of a general fund, and you're given, it's associated through a centralized ledger to your account. And so, on the sort of the back office side, they may be entering and taking coin on and off the blockchain, but not in all cases. And if there were a bankruptcy, or you got mixed up with a fraudulent offshore platform or something along those lines, and those sites disappear, you may not be able to get your money back. And so those are a couple of big risks to consider. Of course, there's always hacking risks and phishing and security risks and those sorts of things, and lost and stolen private keys, and all of this really kind of boils down to self-custody and the issues with self-custody, because people again assume that if their money's in the bank, it's safe in the bank. But if you're walking around with a thumb drive in your pocket, you have your bank vault in your pocket, and if that gets lost or misplaced, or someone gets a hold of your private key or other information, those assets might be gone. One thing to really keep in mind is that these are new and novel technologies, and new and novel markets, and so it's hard to predict sort of how they'll relate to different market conditions. Of course, we talked about high volatility and liquidity risk, run risk, which evidenced itself recently with some stablecoin issues, is something to keep in mind. That most of these products, or all of these products, frankly, are not federally insured. So even though they may assume, or say that they're insured, it's not FDIC, it's not NCUA, it's not SIPC. So you have to really take precautions there. And of course, the fraud risk. Now, we lightly touched on the fraud risk on this particular flyer because there are only so many risks we could put on one page. But if we go to the next slide, we have a whole other flyer dedicated just to the red flags and things to avoid. And here we have things like guaranteed oversized returns. One thing that we commonly see is these scams that originate on social media. They'll give you a pitch, something along the lines of, if you give us $1,000, we'll give you $10,000 in a month, right? And if you invest 5,000, you'll get 50,000. Well, it really doesn't matter in the grand scheme of things how much money you invest. Your returns are not going to go up based on how much you commit, right? What makes returns increase are higher risks. And so anytime you see those sorts of advertisements or pitches, those are something to avoid for sure. A lot of platforms will make loan offers or offer to let you trade on excessive margin or even match your investments. And really those are done mostly to pull in more and more of your money. And these tend to be fraudulent sites that make some of these offers. And what you tend to find when victims go to withdraw their returns, suddenly they're told that they have to pay back those loans, or there's a fee or a tax or something along those lines. And so a lot of these things, these loan offers and matching fund offers may be attractive at the beginning, but when it's all said and done, it really comes back to bite people at the end. Another common red flag is these platforms that will only accept digital assets to open an account. And in many cases, what we've seen is the fraudsters, oftentimes via a romance scam or a friendship scam, will walk the victims through the dollar to Bitcoin or dollar to ETH or dollar to name the stablecoin conversion process on a legitimate platform, and then require them to send that money to an offshore entity. And when that happens, they're really down the rabbit hole at that point, because the reason why they do that is because a lot of these transactions are immutable. They can't get their money back, and that sort of thing. So that's definitely a red flag to watch out for. Why don't we go ahead to the next slide? There are also a number of recent reports that have come out that I wanted to highlight, and if you're a counselor or an educator, these might be beneficial to provide you with some background and some knowledge. The Department of Treasury report on crypto assets includes a lot of sort of background around how the crypto asset market ecosystems work, some background in terms of performance over recent years, some key terminology that might be useful for you, trends, and what are some uses and opportunities in the crypto asset space, and a big section on risks for consumers, investors, and businesses. And for the sake of this conversation, that would be really the point that the chapter that I would really spend some time with, because it really spells out a lot of these risks very clearly and help you understand sort of what some of the fundamentals are. And then the opportunities and risks for populations vulnerable to disparate impacts. And so that's one that I would recommend. And if you want, go ahead and take a screenshot and save that for later. I'll also be sending out an email after the program with some of these links in them, or you can, again, feel free to email me for a copy. Next slide, please. There's also the President's Working Group created a report, I think late last year, on stablecoins. Again, it explains what they are, how they're created and used, participants, who uses stablecoins, how they're used, and the role that they play in the decentralized finance space, or DeFi, and some of the risks and regulatory gaps that exist around stablecoins. And the next slide. The last report that I'll mention, and this just came out, I believe, on Monday, so it's brand new, hot off the press. And this is from the Financial Stability Oversight Council, and it speaks to the financial stability risks associated with digital assets. And this is more of a sort of a macro level look, what impacts and effects this has on markets. And you can see from the bullet points, many crypto asset activities lack basic risk controls to protect against run risk, which we mentioned with the stable coins, or to ensure the leverage is not excessive. There's a section that speaks to crypto asset prices that appear to be primarily driven by speculation and what effects that has. Many crypto asset firms or activities have sizable interconnections with crypto asset entities that have risky business profiles and opaque capital and liquidity positions, and operational risks that may arise from the concentration of key services from vulnerabilities related to distributed ledger technology. And those are some of the main points that are included in that report. Can we go ahead and go to the next slide, please? There are some additional resources. These are some things not only from the CFTC, but also I think we have some from IOSCO and FINRA up there as well. We'll let you take a screen grab of that, and I think the links for the other reports are on there as well. So feel free to make a copy of that and use those as you will. Next slide, please. At this point, what I'll do, let's go back to the group, to the panel. I have one more question, and I would just ask, sort of as we maybe exit the conversation, what is maybe one call to action that you would leave with educators and financial professionals who are listening today? What would be that one call to action, Andrea?
Keep reading. The more you know, the better you're going to be able to help the people that sit across the desk from you. So understand their humanity and the behaviors that are going on, and help them get to the bottom of it and their real why.
Thank you. Shayla?
Well, I would echo trusted sources. identified financial professionals, or certainly those who are doing work in the financial services market, be it in their community, their church, or their school.
Thanks. Toby.
Yeah, I think those are great. I think also just not to overcomplicate things for people as you educate them. I think, don't, make sure that people understand as much as they need to, but also understand they don't need to understand exactly how a block is added to a blockchain to make a sound financial decision. There are much more important inflection points and sort of evaluation techniques before you get to the technology. So don't, I think, take some of those barriers away, but replace them with actual things that are really broad financial literacy techniques.
Thanks. And Jerry?
This is a mindfulness moment because I think the way, financial educators, counselors, coaches, the NGOs, the government entities, we're also passionate about what we do, and we're doing it for the right reason, right? But we need to step back and make sure that the messages that we convey are, appropriate to the audience that we're delivering them to, and that the way we talk, especially the way we talk about victims, doesn't cause more harm, right? Doesn't keep people from wanting to come forward. And I know that coaches and counselors are trained not to be that way, but sometimes even unintentionally, even with the best of intentions, we end up saying things that make people who have made a mistake afraid to come forward or unwilling to come forward because they're embarrassed or they feel like they're going to be re-victimized again. So again, that sort of bring the mindfulness element into it, because when people have made costly mistakes, that's when you're all the more important.
Yeah. Thank you all for your comments. They were all very, very useful. I think I might add maybe one more, and that would be, expand your network. Get out there and talk to the local library or the local civic organization or your church and faith organizations, and let them know that you're not there to sell, you're there to educate, and you'd be surprised on how far that goes. And we think a lot about new investors and young investors and the problems that they often fall into. And it's true that those DIY, do-it-yourself sort of investors do rely on Google and social media a lot. But more often than not, the first person they turn to for a question is maybe mom and dad, friends and family. So if you're a money nerd like us, be willing to share the information and talk to your friends and family and let them know that you're there as a resource. So that's all I have for today. And I want to thank, I wish we could hear the thunderous applause from the metaverse out there that we're speaking to. But thank you all from the bottom of my heart for joining us for today's panel. Thank you to the audience for participating in the conversation. And we'll be following up with an email to provide you with maybe some additional resources or some, give you the opportunity to maybe sign up for some future notifications. I hope you will participate in that. And thank you all. That concludes our panel, and we'll take a brief intermission, and then we'll come back at 1:30 with the next panel. Thank you very much.
Thank you so much for having me.
Thank you.
Thank you. Bye all.
Bye.
Great. Thank you so much, Monet. And good afternoon. Welcome to the CFTC's World Investor Week event, meeting the demand for understanding risk in financial education. If you're just joining us, we just concluded a great conversation around finfluencers and the process to understanding socially mobilized investing and how we can be mindful of the risks. But there's good reason to continue watching, because this panel is also team to the moon, but rather than Reddit and TikTok users, this rocket ship is filled with regulators. Welcome to the Future of Money, the Changing Landscape of Currency panel. I'm Siobhan Kershaw, Senior Innovation and FinTech Advisor, proud HBCU graduate, and a champion of innovation and lifelong learning, currently working in the Office of Technology Innovation with the Commodity Futures Trading Commission. Joining me today are our esteemed guests and leaders representing various innovation hubs from across the federal sector. Starting with Young Chow, affectionately known as EYC. She is the director of the National Cryptocurrency Enforcement Team for the U.S. Department of Justice. EYC, good afternoon. Thank you for joining us.
Thanks, Siobhan. Great to be here. Thanks for inviting me.
Tricia Turner is the Senior Advisor for Digital Asset Strategy Team for the Internal Revenue Service. Tricia, welcome and good afternoon.
Thank you, Siobhan. I got to be quicker with that mute button.
No worries, you're with us. That's all that matters. Morgan Ward Doran is Senior Strategy and Innovation Advisor for FinHub at the Securities and Exchange Commission. Good afternoon, Morgan. Good to see you.
Hey, Siobhan. Glad to be here. Thanks for inviting me.
Great. And my longtime colleague, George Harada, Director of the Office of Technology Innovation for the Commodity Futures Trading Commission. Good to see you, George.
Great to see you, Siobhan. And I tell you, no one can beat you for introductions. That was all your to the moon and everything else. I mean, I was smiling the whole way through. I could see Morgan sort of breaking a smile there.
Well, we do it for the people. Yeah.
We do it for the people. Fantastic. It's a pleasure to be here. Thank you for the great introduction.
Great. I'm glad you're here. Yeah. We're public service at heart. So that's our aim. Listen, panelists, welcome. It's good to see you. We've got a lot of ground to cover. So I'd love to dive right in. For those of you joining us via Zoom, feel free to submit your questions so that we'll be able to address them accordingly. In keeping with our theme, we realized that you can't really begin to talk about the future of money and changing the landscape of currency without understanding your roles within that ecosystem. So it's appropriate for us to conduct a little bit of a roll call here. Tell us a little bit about your offices and the vital roles that each of you play. EYC, can we start with you?
Sure. And I think it's probably worth explaining a little bit, given the audience, how what the Department of Justice does, which seems like a fairly straightforward issue, but in our realm, we investigate and prosecute criminal violations in support of protecting the American public from a variety of different threats. What does that mean with regard to the National Cryptocurrency Enforcement Team? Well, that was stood up because the department realized that there was a need to have a centralized set of subject matter experts that dealt with digital asset issues to support the department's work in digital assets, because we're seeing it in all sorts of different types of criminal cases, but also to pursue our own investigations, especially those focused on the infrastructure that helps facilitate the use of cryptocurrency and digital assets to further other criminal activity. Among other things, we also set strategic priorities regarding digital asset technologies, identify areas for increased resourcing and focus. And we're trying to tackle some of the more innovative applications of existing law to novel uses of digital assets, including through the coordination that we have with our domestic and international law enforcement partners, our regulatory partners, and with private industry to have a unified front to combat the criminal use of digital assets. So that's sort of what our team does. We're housed in the criminal division within the Department of Justice, but we have people drawn from throughout the department. And I'll talk about this in a little bit, but we also have just created a network of 150 dedicated cryptocurrency and digital asset specialists across the department called the Digital Asset Coordinator Network in order to sort of meet the emerging threats that we see from this arena.
Exciting work. I'm looking forward to hearing more about that. Trish, would you like to go next?
You bet. So again, thank you for having me today. As a senior advisor and program manager, our function here for the IRS, the Internal Revenue Service, is a little bit more straightforward. We do work for compliance both on the civil and criminal side, although our investigations do take some different turns, and definitely referrals come from those different turns that we do take. I have spent the last 7 years of my almost 18 years at the Internal Revenue Service immersed in digital assets, supporting different investigations, both criminally and civilly, on those work streams. And this last January, I was assigned to be the lead supporting the strategy to facilitate this going forward. So our strategy really going forward is to guide compliance, planning, implementation, and then operationalization of our strategy. As you can imagine, there's a lot to go with implementing the Infrastructure Investment and Jobs Act that came out last November. I'm working through that along with aligning our training, communication, and technology needs to meet our program's goals. So I do work with all the business operating divisions. We are working to leverage all resources, both in domestically and internationally, supporting compliance, and then collaborating our resources. I also work to help assist develop audit techniques, monitor program cases, and then prepare technical and procedural guidance. I've also, again, worked with both domestically and internationally with the different programs, helping write some training for the Joint International Tax and Enforcement Committee, MAGITSIC out there. And then just to kind of finish it up there, the IRS's focus is promoting voluntary compliance and employing enforcement actions when warranted. Again, I like how you started that, Siobhan, today. We're embracing digital asset innovation and that distributed ledger technology, but again, also making sure that we are taking care of our tax obligations on the other end. So we'll talk a little bit about it today, but again, thank you for having me.
Awesome. It is important that we're embracing the responsible innovation and moving that forward while looking at the risk. And it sounds like the IRS has several irons in the fire, so you all are quite busy. Morgan, would you like to share with us what the SEC is doing?
Sure. I'll start by saying that the SEC's got a lot of offices and divisions, and I think most people have probably heard of one of them, which is enforcement. But I work at FinHub, which is a fairly small office at the Commission. We try to have an outsized impact. Our core mission at FinHub is to consolidate and coordinate fintech-related work across the Commission by providing a central platform for internal and external engagement. So that means both people inside the Commission and people, the public and academia and people across the world. We use a hub and spoke configuration at FinHub, which means we just have a small core staff, but then we have delegates across the Commission that make up the spokes, and they are taken from offices and divisions that most people probably have never heard of, like Corp Fin, Trading and Markets, OIA, OIEA. And so we have folks from the entire Commission who participate in the fintech work at the FinHub. Internally, we help build and lend expertise to all staff across the Commission and facilitate communications regarding fintech at the Commission. Externally, we provide a platform for public engagement on fintech, which we'll discuss a little bit later. And we liaise with domestic and foreign counterparts, like some of the folks on this call, and we try to foster educational opportunities. The topics that we tend to cover are kind of in the name, fintech, but most recently that has focused primarily on crypto and digital assets and blockchain technology, which is the focus of this panel.
Now we're sharing that sentiment. No, go ahead.
Quick shout out to DOJ, because that's a agency that I used to work for and love. So sorry, CFTC and IRS, you guys never hired me.
Yeah, now you've got the rest of us jealous. We didn't get to experience your wealth of knowledge. George, will you share what the CFTC is doing?
Sure, exactly. And you know what, and you may have mentioned this already, Siobhan, but just in case I missed it, and I should probably throw out this disclaimer that, you know, all of us obviously are all from the government, and all the words that we're using today, I feel like I can speak for everyone else to say that we are only speaking for ourselves, which is to say we're going to talk about a number of things today. We're certainly not endorsing any firms that we might mention. We're certainly not, at least I know that I am speaking on my behalf with my own opinions, and they're not necessarily the opinions of the chairman or the commissioners or that sort of thing. Again, you might have mentioned it, but I just, out of an abundance of caution, just wanted to make sure that we're clear in case anybody quotes us as saying the CFTC said this, or the IRS said that, or the SEC said whatever. In fact, we've already got the endorsement. The SEC has endorsed the Department of Justice. So there you go. That's a big thing for Twitter. But that's Morgan's opinion, and we'll
That's
leave
just
it
my
there.
opinion. That was a personal note.
Yeah, exactly. So anyways, so telling you a quick thing on, so I, as Siobhan and a number of other people on the call know, I recently was promoted to the director of the Office of Technology Innovation. The OTI was originally in its earlier incarnations known as Lab CFTC, which we helped launch back in 2017. But in its latest incarnation, our innovation office really focuses on three things. And everybody that's ever run the Lab CFTC and now OTI has always come up with an acronym. So I will give you our acronym. Our acronym is ICE. And of course, when you say ICE in the government, people immediately think of another group. That's not us. We're simply stick with our own acronym. ICE stands for Innovation, Consultation, Collaboration, and Education. But let me take that apart one thing at a time. The first is innovation. So we're always on the lookout for firms that are out there, particularly in the crypto sphere, that have interesting data sets, interesting tools, things that we can take internally to CFTC and help make CFTC more effective at what we do. So that's the innovation part, helping CFTC to innovate and to move forward. And again, that's broader than just crypto. That's things like artificial intelligence and machine learning and those sort of things. Consult and collaborate, that's where oftentimes we're asked by commissioners and division heads, or even people within the CFTC to consult on a particular case or to give some advice one way or another, help and understand something. Collaboration, that's broader. That's with collaborating. We have different groups inside CFTC, like the Financial Industry Working Group, or broader than that, the FSOC, the GFIN, some other things, interacting with other innovation offices, such as in the past, certainly we've collaborated a lot with the SEC, and recently started to work with innovation offices such as the IRS and other places. So we're excited about that. And finally, the idea of education. We are a small, as Siobhan would say, small but mighty group in OTI. And so our goal really is focused heavily on education, making sure to educate the people within CFTC, and even broader than that. We've done, we've really trying to up the game of the federal government in terms of understanding crypto and the implications around it. So, but with that, I'll hand it back to you, Siobhan. Thank you.
Yeah, no, and it seems like every agency is tackling digital asset enforcement in different manners. George, I'd really love to kind of start with you to kind of revisit a technical event that happened not too long ago. Can you share with our audiences at a high level what Ethereum accomplished at 2:43 in the morning while you and I were watching these watch parties on YouTube on September 15th with this long anticipated merge, and how this consensus shift has the potential to accelerate economic transformation while minimizing energy consumption, both for fintech transactions in the present and in the future?
That's a great question. And as you noted, a number of us did stay up late to watch the launch party. There were about 41,000 people that watched it remotely. I know you were watching it from your home. I was watching it myself at 2 something in the morning, because we were very anxious to see how it would turn out. And before I get into it, I would say the analogy that a lot of people have come up with is it's likened to switching from an internal combustion engine, say, to an electric motor while going down the road at about 100 miles an hour, because there was no downtime. Now, what did they do? It was the moving from proof of work, which is a very energy intensive approach to cryptocurrency mining. And some say that Ethereum was using the equivalent of all the electricity used by a country like Switzerland. When Vitalik Buterin created Ethereum years ago, he did hope to move to proof of stake versus proof of work in about a year. It took about 5, 6, 7 years, so it took a while. The idea behind proof of stake is instead of it is to say, I am going to, as a perhaps an investor or a participant in the Ethereum ecosystem, I'm going to put a certain amount of Ethereum down, and I'm going to lock that up as a way of saying that I'm going to act in an honest way. And if I go ahead and validate blocks of transactions in an improper way, then the entire system can start taking my funds away. So it's a little bit like putting down some earnest money and saying, I'm going to act honestly, but if I fail to act honestly, I have some skin in the game. And that way, all the people that are staking, in other words, proof of stake, all the folks that are staking their hard-earned Ethereum, they are basically saying that we will act honestly, and if we fail to act honestly, or the other thing they talk about is failing to show up for a vote, because blocks have to have 2/3 of the participants voting. And if people decide, if like in this particular call, if half of us, if there's, let's say there's 4 of us that are participating in this, and we fail to, if like 2 of us decide not to vote, well, then the next block could never be written. So there's also a slashing condition where if you fail to vote, you will lose some of your crypto till eventually, if you lose enough of it, the 2/3 vote will naturally happen from those that are still voting. So what are the major benefits? The big one is, as I alluded to already, sustainability. Reduce the energy consumption by a factor of 1,000 instead of using the amount of energy that Switzerland used. It's really a very, very minor amount of electricity. It really prepares Ethereum for the future. That's scalability, and that's things like sharding and some other things. Some people equate it to going from a 1-lane road to, say, a 16-lane road. And so the throughput, boy, I tell you, anybody who's gone south on Route 95 knows that you would sure love to have a 16-lane road instead of the 2 or 3-lane road that they have. That would be fantastic. So you could understand what an impact it can have for that scalability. So they had to do the Ethereum, this key component, to move forward, and it's less vulnerable. Proponents of this change said it's less vulnerable to 51% attacks. And a real plus is that the ETH supply has stabilized. I'm just going to ask you, Siobhan, can you still see and hear me? Because something strange happened to my screen.
Yep, we can still see and hear you.
Okay, my screen just went blank, but I'm glad that you can see and hear me because I see nothing now. All right, so the bonus again is that ETH supply is stabilized instead of growing by about 4.5% per year, which was sort of inflationary in the supply of Ethereum. Now it's basically flat. So that's a great thing. Of course, there's risks. There's lots of things that are built on top of crypto, like the DeFi. There's some concern if there's a unknown bug that comes out that could cause that to collapse. Again, I'm not saying doom and gloom. I'm just saying if there's something significant that was missed, it could have a significant impact on the crypto ecosystem. And there are some that are concerned that it has more centralization via these staking pools. So that's it in a nutshell. Thank you for the question.
No, and that's a great segue to kind of talk about decentralized finance and the DeFi landscape. And Morgan, I'm going to point this to you. The DeFi landscape, it takes the innovation of DLT and blockchain a step further, and it really extends beyond simple transactions to support complex financial instruments like derivatives products and collateral-based lending and even yield farming with predictive markets and smart contracts at its core. But what we're not so naive to believe is that the advancement of this tech won't arrive with some violators among this new crop of startup ventures. And so can we talk about what the SEC's approach here is to protecting investors and really the American public?
Yeah, great. Thanks. I appreciate the question. I mean, obviously, this is an important question for the United States, for the world, and more specifically to the SEC. the technology is amazing, and it's been brought on a lot of advancements in terms of the ability for everyone to participate in some way or another more easily in some of those innovations regarding financial technology that you mentioned. And while DeFi and blockchain generally are really interesting technologies and have advanced the ball, it's important to note that at least at the SEC, and I think most agencies, it's ultimately the activities themselves that matter to us, not the technology used. The key message is that we're technology agnostic. So although we're FinHub, and my group's FinHub, and everybody on this call is FinTech related in some way, in some ways, the technology doesn't matter so much as what the activity itself is. And so if someone's violating the federal securities laws, it doesn't matter to the SEC whether you use a phone call to do it in a boiler room, you use a postcard, a telephone, or blockchain. And it doesn't matter what you call it, is what matters is what you do. And so as our director of enforcement stated in a speech a couple of weeks ago, we will continue to bring actions regardless of what label is used or what kind of technology is involved. And that's important to keep in mind. I think people sometimes think that the United States government, the SEC, DOJ, CFTC is picking on crypto. And I don't think that's an accurate statement. I think in reality, we do try to be technology agnostic, but as we've seen, at least I've been at the SEC for 15 years and in government for 20, all new innovations go through a period where bad actors take advantage of it. And every new, it's not even technology, every new thing that comes out, there's a leading edge where there's the innovators and then there's the people taking advantage of the new thing. So with that said, at the SEC, I think our key approach is to encourage a phrase that we've already used here, which is responsible innovation. And what that means in practice for FinHub is that we try to support builders and creators, but then on the enforcement side, with the understanding that there are already established guardrails with regard to the securities laws, and they have to be followed. And so what we do here at FinHub is try to facilitate knowledge development and information sharing both inside and outside the commission. And we try to become subject matter experts on these new technologies like crypto and some of the other fintech advances that George mentioned. And we try to help staff inside the commission have a better understanding of these new technologies so that they can form intelligent decisions about their cases and in the case of enforcement, the cases they're going to bring. At FinHub, we try to give innovators a place at the SEC where they can come and discuss their projects and feel like they have a face at the SEC that isn't just enforcement. So the bottom line is that to the extent there are securities law violations going on that involve crypto, we being the commission will go after those with the same vigor that we would any other securities law violation. And that at FinHub, our goal is to help all of the commission, including the Division of Enforcement, understand crypto better and understand fintech better.
Absolutely. And shifting as we talk about enforcement, EYC in March, President Biden signed the first of its kind, this executive order on digital assets, really directing federal agencies to lead strategically on their approach to crypto oversight. And so the order gave the Attorney General 6 months to come back with a report on the role of law enforcement agencies in detecting, investigating, and prosecuting criminal activity related to digital assets. Can you talk to us about how the president's executive order influences the direction of the national cryptocurrency enforcement?
Sure, I'm happy to do so. I think to begin, the department welcomed the White House's development and issuance of the executive order because it set forth for the first time a framework for a real whole of government approach to address the risks and harnessing the potential benefits for digital asset technologies across 6 different areas, including consumer investor protection, promoting financial stability, countering illicit finance, U.S. leadership in the global financial markets and economic competitiveness, inclusion in the financial markets, and responsible innovation. Of course, The DOJ has a specific focus, as I said, which is to counter criminal activity. And so among those areas, we're most concerned about consumer investor protection, as well as countering illicit finance, both of which we're doing and have been doing for quite some time. And even before the executive order had been issued in March, the department understood that it needed to prioritize digital asset issues in the wake of the rise of the asset class and focus on ways to ensure that the department was best prepared to deal with the ever-evolving challenges posed by the illicit use of digital assets as people innovate. As Morgan made very clear, we are also seeing innovations in the use of criminal activity as well. So in terms of how we view ourselves in our role, we have this set out in great detail, not just in one report that we just issued in June about the role of law enforcement in detecting, investigating, prosecuting criminal activity related to digital assets, but also we had a report in February that related to strengthening international law enforcement cooperation for detecting, investigating, prosecuting criminal activity related digital assets. I think what is important about the executive order is that departments and agencies across the federal government each have roles to play to ensure that with the development of this asset class, we can have sort of the best outcomes possible for ensuring that there is the fostering of responsible innovation while minimizing the risks of that innovation to the American public. And where we can get those best outcomes is when departments and agencies can work together on whole of government solutions, each bringing their own unique expertise and authorities and background to bear on an issue in order to ensure to have the right balance in terms of innovation versus ensuring that there are minimization of the risks that are posed.
Absolutely. And so interestingly enough, we're not only seeing, as you've mentioned, the trends in some of the nefarious activity on the dark web, but we're also seeing custodial challenges and cyber concerns and hacking on the conventional web, right? And one of the particular things that kind of comes up as point of conversation during dinner with my family is these conversations around virtual bribery, which is trending in cyber crimes across the globe. And so EYC, as your office kind of continues to serve as one line of defense, how can market participants identify these illicit cryptocurrency schemes, and how are we preemptively protecting ourselves?
So this is an excellent question. And unfortunately, it's a very complicated answer, in part because, as I'm sure your dinner conversations have observed, what makes this challenge with regard to illicit digital asset and cryptocurrency schemes so difficult is because this type of criminal activity comes in sort of all different shapes and sizes. And so there are sort of a variety of different ways in which market participants can think about these concerns and try to make sure that they're best positioned to deal with them. I mean, one thing that we have said, and we do believe, is that in many ways, oftentimes the cryptocurrency platforms are oftentimes in the best position to help mitigate some of these risks, in part by having strong sort of risk management principles in place, compliance programs, ensuring that they have anti-money laundering and know your customer policies that are up to the standard that is expected, in part because those are the types of activities, and their own risk management are the types of activities that allow for them to detect in the first instance a lot of criminal behavior that might be happening or fraudulent behavior that might be happening on their platforms. But, just to sort of give some broad principles to think about it, with regard to cryptocurrency from a cybersecurity perspective, obviously there's ransomware, there are other types of bribery and extortion situations that aren't ransomware related that deal with cryptocurrency. And in that sense, I think some general principles with regard to basic cyber hygiene work well to try to mitigate from an individual investor's perspective some of the issues that may be involved. And some of these are pretty well known, things like don't click on, it seems very basic, but don't click on strange links. Be on the lookout when you're looking at a link or an email for domain names that look as though they're coming from the FBI or they're coming from a known cryptocurrency platform, such as a cryptocurrency exchange that you may be doing business with, but are in fact just impersonating them, especially not just domains, but also the URLs themselves. Try to refrain from downloading or using suspicious looking apps in order to, and try to do some due diligence to make sure that when you're downloading apps, that you actually know that they are coming from a legitimate source. And use common sense. Oftentimes when something seems too good to be true, perhaps it is because it is too good to be true. And I think that principle is a guiding one that should be used more generally when it comes to investment opportunities writ large. So putting aside the sort of cyber perspective, I think there is this sort of combination of a lack of understanding about how some of these technologies operate, plus sort of the FOMO, fear of missing out propensity that is really causing a lot of harm to the consuming public writ large. So again, think about what you're actually trying to invest in, knowing that on some level, a lot of these newer technologies and tokens are relatively volatile asset class. So understanding that that is the case, think about whether or not there are guaranteed 20% high risks of returns. Why would that be the case? That's usually a classic, example of putting in the Madoff context of fraud. And it's one that you should probably think twice about. Is this platform registered as a broker dealer? Is it registered as a cryptocurrency exchange with FinCEN? Those are sort of questions about the background. Are they registered with their state regulators? These are questions about the background of the platform you're interacting with that you would probably take for granted when it comes to normal financial institutions because you assume that they're properly registered, but is sort of an emerging issue with regard to digital assets. Is there some sort of unexpected, increase of account values that you can't really back up with anything else sort of that you can find in publicly available sourcing? That's another classic sort of example of fraud that happens. And again, if it sounds too good to be true, it probably is unfortunately too good to be true. Oftentimes when you have incredible rewards on your return to investment, it's because there was a high risk that was associated with that asset. I think that's generally true with a lot of digital asset investments, but in particular, because we're seeing, fraud, just reported fraud on the scale of billions of dollars in this area, it really requires a certain level of scrutiny from individual investors who are thinking about participating in and making investments into these types of platforms.
No, and that's incredibly helpful because a lot of what you reiterate, I think all of our agencies are trying to do a better job at communicating what are the risks, how do we educate on really these complex investments, and where do we move from here? Trish, now that we know a little bit more about this emerging technology and some of the players, I want to switch gears and talk about the tax implications of those who want to become more hands-on. It's vital for any market participant to possess a clear understanding of what the IRS's official interpretation of tax implication for digital assets. Can you offer some insights around taxable events as it relates to crypto investments, especially so that new entrants in the investor ecosystem can avoid incompliance?
Sure, thank you, Siobhan. This a great question here. So the IRS, we view digital assets as property, and we treat them as such for federal tax purposes. Therefore, that means general tax principles applicable to property transactions apply to those transactions. For purposes of my discussion here today, I'm going to quickly highlight a couple terms that have morphed or have changed throughout our different guidance, and it's not to mean that any of them mean anything different. We're not carving them out any differently. They're all treated as capital assets. In our first guidance that we issued in Notice 2014-21, it was virtual currency. I know in 2019 we did use cryptocurrency, and then in our last IIJA, the Infrastructure Investment and Jobs Act, it was digital assets. So, not to confuse anybody, not to say that at one point we called it currency and now we're not, or anything like that. We still look at it all as being a capital asset. So wanted to kind of set the groundwork there in that foundation. In Notice 2014-21, like I noted, it was our first guidance that we issued back in 2014. And again, that term virtual currency was used. It provided that, generally all transactions with digital assets, whether it's to pay for goods or services, or it's something we received for doing any types of services in a real world economy transaction, may result in a tax liability. So depending on how you receive that or how you transacted in that could mean an ordinary income, or it could be a capital gain or loss. But I first also want to kind of set the playing field there as well. Just because you purchase a digital asset, that does not mean that that purchase of the digital asset is a taxable transaction. So it's just like any other purchase of a property, a boat, car, any other asset that you may purchase, that is not considered a taxable transaction. However, your investment in that, those US dollars that you put into that, does become the basis for your asset. On the other hand, if you are a taxpayer who receives a digital asset for payment for goods or services, you must include that fair market value at the time of receipt of the digital asset in ordinary income. And then some may ask, well, what is the time of receipt? And we look at that as when it was recorded on the distributed ledger. So a couple of things there that are key, obviously, as you are determining what that fair market value is, and then when you've received the digital asset. Along with that, we also have taxpayers who exchange property for digital assets. We consider that a taxable transaction as well at the time of the disposition of the property, and then the new digital asset or the property is received. And then you would recognize that capital gain or loss on the disposition. The sale or exchange of a digital asset will rise to income recognition event. So if you don't exchange it for another digital asset or another property or capital asset, just the sale or exchange does also, you go back into either the US dollar or another crypto, virtual currency, whatever you want to call it. It is a recognition event. A taxpayer who also sells digital assets for US dollars, who held the digital asset as a capital asset, meaning the taxpayer is not in the trade or business of selling digital assets, will recognize a capital gain or loss on the sale. So as I'm going through this list here, you can imagine it gets a little confusing, and it's a little bit here that you kind of have to think back on. But then again, likewise, the sale or exchange of digital assets for other property, again, including other digital assets, does give rise to that capital gain or loss determined by taking the amount realized, and that means the value of the property over the digital assets received over the taxpayer's basis in the digital assets sold or exchanged. So within Notice 2014-21, I'm sure that was a lot when those came out, and we issued some FAQs back then. I think there were 15 when we initially issued the Notice 2014-21, and it's up to about 46 FAQs now. We've issued some additional guidance. We can talk about that a little bit more as well. The revenue ruling in 2019-24, a couple CCAs, and then a PLR, private letter ruling. So there's quite a bit of advice out there as far as the guidance goes. But again, that's our initial foundation between how we treat capital gains and losses and the ordinary income for digital assets.
Yeah, and all of that becomes particularly interesting as we become more familiar with the terms forking and airdrops. I'm certain our audience is curious. Are there taxable events that occur based on receivership? I think I heard you say it's at the time that it's really deposited with the exchange. So perhaps the ETH merge and the airdrop of ETH POW tokens are a good use case here. Can you kind of break that down for us, Trish?
I sure can, and that does get a little complicated. In 2019, users had, prior to 2019, asked for a little bit more guidance and clarity surrounding airdrops, hard forks, all these terms that were kind of being thrown around out there. And we issued 2019-24 back in October of 2019. And what that notes is when a hard fork happens, which the hard fork isn't necessarily the taxable event, right? So I'll get to ETH in just a moment, but the hard fork is the change in the protocol. An airdrop may or may not be a result of a hard fork. When it is, that is when a taxable event may occur. So when that airdrop happens, it's a distribution of new units of cryptocurrency, virtual currency, digital assets onto the distributed ledger. When it's received by your address and you have dominion and control over it, that is when it's a taxable event. So again, it's not necessarily when the merge happened, and the merge in and of itself didn't necessarily create a hard fork, but we do have airdrops after that were a result of it. But again, it's not the hard fork itself either. It's when the event of the airdrop happens and you have receipt of it and it's dominion and control. Now, what's interesting about that is in an airdrop after subsequent hard fork or holding an asset, anytime it's airdropped to you, that's ordinary income, which complicates things a little bit further. So I'll go through a small example here. And right before I go through that, I want to explain real quick here what dominion and control is. So dominion and control, for purposes of being able to say that it's received and it's a taxable event, means that the taxpayer or the user had the ability to transfer, sell, exchange, or otherwise dispose of the asset. So that also, I mean, that's what the term there means for us. And what happens here now, let's give a quick example on the ETH merge. So when ETH went from proof of work to proof of stake, that consensus mechanism change and the change in the protocol didn't necessarily create new, that in and of itself didn't create new assets. That was a change in the technology underlying the assets that you already held if you held an ETH asset. If because of that, in the events that then transpired afterwards, there was a hard fork or there were airdrops or whatever other terminology may be used in the holders that had this in their wallet, that then becomes a taxable event. So when they received that those additional units of those digital assets into their wallet, the time of receipt, and they had dominion and control over it, that becomes income to them. In this example, I'm going to throw out some dates here just because random dates to not tie it to anything. So if on June 1st, I had 5,000 units airdropped to me. So you get out your pens here just to kind of walk through this with me here, okay? So on June 1st, I have 5,000 new units of an asset that are airdropped to me as a result of a hard fork. And on June 1st, I had dominion and control in my wallet to do whatever I wanted with those assets. And the value of that, let's just say, is 20,000 to make it easy. So on June 1st, I have ordinary income of $20,000 to be reported on the front of my tax return. Now, it's a very volatile market. And 2 days later, I start seeing the volatility there and I'm just going to sell. So I want to sell on June 3rd. And I sell because it's already going down at 10,000. You can see there, I am already realizing a $10,000 loss. And how that happens is you have that ordinary income on the front of your return. And then you also have to recognize the capital gain or loss on the sale or disposition of those assets, whether it's 3 days later, 5 days later, or the next year later. That is reported on your 8949 less your gain on your ordinary income, because you can offset it by your basis there of the 10,000. Now, also with that, you are limited depending on how many other short-term gains you may have. If you don't have any other short-term gains to offset that, that $10,000 loss that you have sitting on your 8949, you'll be limited to 3,000 of that loss carry forward. So as you can see, if those numbers are extrapolated out a little bit further, you may have to make some arrangements to pay that ordinary income gain that you would have to report in the front of your return.
Right. And Trish, if I could just chime in, it does look like in the chat there is some interest around this particular question. So Lisa is asking, do I understand correctly, if a person is paid in crypto, it is reportable as ordinary income and taxed as such. And then if you sell that same crypto, then it's taxed as a capital asset. And I think that's
No, great question. I can answer that. So yes, if you receive it as income, it's ordinary income to you. When you go to sell that, however long you hold it, that's your first question. If you hold it less than 12 months, it's a short-term gain or loss. If you hold it longer than 12 months after that, it's a long-term gain or loss. But your basis in your sale as the capital gain or loss becomes the income that you recorded as ordinary income. So that becomes your basis in your asset when you go to sell it. So you are correct.
Yeah, and there was another question, George, I wonder if this would be appropriately pinged over to you. If someone misplaces their crypto or digital key, is it retrievable?
Yeah, that's a great question, and certainly one that people wish the answer was going to be different than the one I'm going to give you. In general, the way it works with most crypto assets that have a single key, here I'm not talking about it like a multi-sig or something like that, but typically there's one private key for every crypto asset like Bitcoin or Ethereum. And if you lose your private key, to this point now, no one has a solution. It's meant to be so highly, I mean, encrypted is maybe the wrong word, but it's set up so that there are no systems out there mathematically that can recreate it. So yeah, unfortunately, it can't be. And there's many famous stories of one guy, for example, who had a hard drive, and back in the old days, he had a bunch of Bitcoin, and maybe the Bitcoin was worth $200 or so, and he just threw out the hard drive, didn't think about it, and then several years later, that $200 worth of Bitcoin was worth like $20 million, and boy, he wished that he could get the private keys to unlock that Bitcoin. But unfortunately, the Bitcoin will just sit there forever on the blockchain until somebody is able to figure out what the private key is, and that's currently not doable. But yeah, unfortunately, if you lose your private key, you lose out. There are hardware wallets that are set up so that you have a seed phrase, and the seed phrase can be used if you have the seed phrase, it can then unlock the wallet and give you all your private keys. But again, if you lose your seed phrase or somebody or you lose your private key, there's no way to recover it. But thank you for that question.
No, great response. Morgan, I want to tag you in. We know about the interagency coordination that's a major priority for the SEC. And in fact, our agencies have successfully coordinated on a myriad of investor advisories, on joint enforcement symposiums, on conferences like this one. And recently it was announced that the SEC would be leading GFIN soup tech efforts. So I'd love to hear more about that, but how is the SEC digging deeper into this technology?
Great question, thanks. This is actually a really fun question for me because most of my career at the SEC, I've been trying to bring technology on board. I wasn't always at FinHub because it's a pretty young office, but back when I was in enforcement, that was one of my jobs. Just sort of going out there and saying, okay, what do we need to understand what's happening in the real world with regard to, you know, insert cool technology here, crypto, dark web, you name it, we were looking at it. And so part of that is keeping an eye on what's happening and trying to find ways, which is not easy for anyone on this call who's tried to acquire something at the government. They know that government acquisitions are not as easy as private sector acquisitions, in the sense of the people who are listening to this call can go home and download any application they want onto their computer, install it and play with it, and they can be up and running a node in a couple hours. It doesn't work like that at the SEC. I'm pretty sure it doesn't work like that at any government agency. So, but with those limitations in mind, we've tried really hard here at the SEC to acquire and disseminate the tools and technology that are necessary to help our staff gain an understanding of this new financial tech innovation that happens, and crypto is a prime example and the easiest one to speak about. But we have done so in other areas as well. So crypto, yes, DeFi, yes, but also social media, cloud computing, AI, machine learning. Those are all areas that we have tried very hard to, I don't want to say keep pace. I want to say keep pace. I don't think I should say keep pace because innovation happens out in the real world at such an incredible pace. People with the ability now to build code on other code, to fork code, and I'm not talking about forking Ethereum, I'm talking about GitHub, GitLab. You as a private individual out there have the opportunity to sort of stand on the shoulders of giants continually and consistently. And so innovation is happening in the real world at such an incredible pace that we probably, would love to be able to keep up with. But I think is all we're trying to do is stay in shouting distance. And so one of the things that we've done at the SEC and specifically at FinHub is created a fintech lab. And that is what that lab is a way for staff to actually physically, well, sort of using a keyboard, touch financial technology and actually be able to engage with it, which I think from my perspective as a former enforcement attorney is really important, because you can hear about these concepts, you can hear about crypto, you can hear about DeFi, you can hear about keys, you can hear about a wallet, right? Like we just had the conversation about what happens if I lose my keys, but unless you've actually looked at your keys, looked at the software application, copied a seed phrase and thought to yourself, okay, where am I going to put this seed phrase? Hint, don't put it in a plain text file. But those sort of questions don't come up unless you're touching it. And so what we've tried to do is create an environment at the SEC where staff can have some of these tools at their disposal. And then we try to help them learn how the tools work. We provide education. One of the examples is that we've installed applications that let us read and run the code that makes up different blockchains. And for some of those blockchains, we've even created our own test nets and transferred tokens back and forth amongst ourselves. Again, this is all test net, so there's no concerns with any actual taxable events for you, Trish. But we are spreading knowledge in a way that just sort of doing a PowerPoint doesn't capture. And so the hope is that we will inform not just the enforcement staff, but also the commissioners, right? We've done presentations to the commissioners so they understand not everybody is sort of crypto native. And so they understand how this works. Seeing data stream live on a computer is different than like watching somebody talk about it like we are on this call. So other divisions, the divisions and offices that propose the regulations, the divisions and offices that respond to proposals, the divisions and offices that engage like we do with our counterparts internationally, all those people at the commission get to be educated in a different way, I think, than you would otherwise be if you didn't get to touch the technology. And going back, to the not just the recent events at FinHub, but the historical actions that we've taken, we've also helped educate other agencies across the U.S. government and across the world. And we have partners across the world, and we've helped folks see the technology that maybe they didn't have the chance to acquire. So, yeah, but it's a really fun world to be in. And I think a lot of the people on this call probably know that firsthand and know how engaging it can be.
Yeah. And I'll just note that we are continuing to welcome your questions in the chat. As a note to address Renee's question, we are recording this session, and this entire presentation will be available on CFTC YouTube in the near term. George, last question here before we kind of move into our lightning round. Morgan makes an excellent point. FinTech development really occurs at the speed of light. How can investors and market participants keep pace with new developments? And what does this mean for expanding opportunities of inclusion for communities of color and underserved communities? How are we engaging with these communities so that they can be apprised and informed?
A great question. And since I don't want to get in the way of the lightning round, it's kind of like getting in the way of the lunch. If you're right in a panel right before lunch, I will make my thing brief. I would say that Morgan really did a great job of sort of explaining some of the challenges of keeping pace. And we do the best that we can here as far as, keeping track of things on the news sites and podcasts and different websites. Whenever I'm looking for the latest hacks and scams, I do go to this website called web3isgoinggreat.com. Fantastic. If you want to be cynical, it's a great website to keep track of what is going poorly. But it really is helpful to understand, to have that all in one list, one place to see things. I will add one last thing and then just hand it back because I could go in more detail about the others, is to say I met with a firm recently and it was kind of fascinating toward what Morgan was saying. For ethical reasons, they don't allow the people that are at their firm to invest in crypto, which I thought was interesting. It's a crypto firm, but they want to try to keep themselves clean ethically. But what they do is they have, because they have a lot of portfolio companies, what they do is they have a bunch of Ethereum and other things, and they have set up at their offices they've got real live Ethereum and real live crypto where you can play with it on their servers. You don't get to keep the money. You can't transfer it to yourself, but you can go in to try DeFi things and try it for real. I think it's Morgan's right saying there's nothing quite like doing it for real. Doing it on a test net isn't quite the same as doing it on the live on the live mainnet. So I thought that was a clever way for them to do it, to say we're going to provide a certain amount of crypto for the people working here so that they understand how this stuff works, to allow them to play with the stuff in real time, simply for learning purposes. So, but as far as the other stuff, people of color, minorities, we are heavily involved in different ways. I know, for example, that I know your background with HBCUs, and I know that you've served in the past as speakers on the HBCU blockchain and fintech summits. We've done things with Hope Global Forum. We've been involved with women of color blockchain conferences. Lots of stuff we could go on, but I don't want to get in the way of the lightning round, so I'll hand it back to you, Siobhan.
That's a lot of pressure for the lightning round to be great. I did want to just mention this one more question that we received for Trish. Does the capital loss from investing in crypto categorize as a deduction from ordinary income tax base?
Great question. I'll make it short for lightning round here. That answer is no, you cannot offset ordinary income. There are very specific rules for capital gains and losses, both short-term and long-term. So no, they cannot offset ordinary income.
Short and sweet. All right. Lightning round question, each of you, if you can come off of mute. If you could create your own token or crypto, what would you name it? George, do you want to get started for us?
Sure. I put some thought into this. If somebody steals my idea, we'll know where it came from.
Yeah,
Can I
we all
trademark it
need
here?
trademark attorneys at the end of this, right?
Exactly.
Yeah.
We'll have to get. We've got a lot of attorneys between the IRS, the CFTC, and all the rest of us, the SEC. My coin would be. I would call it the Attaboy coin. So it would be a soul-bound token. So it's basically something that can only be attached to you. You can't trade it. You can't sell it. Get rid of it. It basically, if you, for example, Siobhan, you've done a great job moderating. I could give you an Attaboy coin. You would have this token, and it's a little bit like if people that are familiar with the military has these things called military challenge coins. So if you've done a good job, say serving in Iraq, somebody might, the commander there might give you a special coin to indicate that you've done a great job. So my Attaboy coin would be something very similar. Again, soul-bound token that it couldn't be traded or given away, but somebody could look and see, wow, look at all these coins that Siobhan has because she's done such a fantastic job, or wow, Morgan's got all these amazing technical coins for all the great work he's done, or EYC or Trish. So that's my idea, the Attaboy coin.
Wonderful. Okay. EYC, you're up next.
All right, I'm going to go old school because George mentioned challenge coins. We have an NSET branded challenge coin, which I don't know if you can really see on the screen. So
yeah,
if I could make my own token, I would just have it be the NSET branded challenge coin in some sort of digital form. But the specifics in the blockchain are yet to be determined.
We will continue to stay tuned. Trish, what about you?
So, again, I tried to put some thought into this too. All the ones that I came up with, I went out and searched, and with over 22,000 coins and tokens on the market, I mean, it's hard to come up with something unique now, very hard. I had a couple, Arcana was an interesting name just because there's got some mystery behind the word Arcana. There's still some mystery there, and I think there's a lot to be learned through the technology. So I went with Arcana. Again, nothing too original, but I tried. They're all taken, the dynasty, all of them. It's all, they've already trademarked it all.
Yeah, the market is flooded. Morgan, what about you?
I have two answers. So because the first one I just thought of when George was speaking, I forgot that the SEC already did this. We didn't actually create one, but we created a site for Howie coins. This was like 2 or 3 years ago, and it was like a spoof site for people who are investing, like what EYC was saying before. It sounds too good to be true. I don't remember the exact specifics, but it was, invest in the Howie coin. So, and of course, for everybody on the call, the Howie is a case from the Supreme Court that helps people understand the elements of an investment contract. So, in any event, that's one. And then the second one is an answer I hope is unique. Well, I think is unique to the panel, which is that I actually have created one, testnet. Okay, and it may be amusing to you all, and it was not meant to be any sort of a butt kissing exercise, but I named it the Valcoin in honor of my friend and colleague Val Stefanik, who's the head of FinHub.
Wow, Morgan, you are a man of many talents. Who would have known that you've already developed one? Well, I will be brief. My coin would be called the Tomorrow Token, particularly because it is vital that we invest in our future and invest in tomorrow. See what I did there with the slogan, tying it with the Tomorrow Token. We desperately need trademark attorneys, but more than that, I will say, George, EYC, Trish, Morgan, thank you all so much for joining us for today's intriguing and informed conversation around the future of money. This concludes our panel, but we invite you to keep the conversation going by following the CFTC, both on Twitter, on LinkedIn, and all of our social media channels, and visit us for more information at www.cftc.gov. And with that, have a great afternoon. Bye, everyone.
Thank you. Bye, everyone.
Bye.
Thank you.
Thanks, guys.
Bye-bye.